Today's tech news moves fast, but understanding it shouldn't be hard. That's why Snarful Solutions Group brings you Connecting the Dots, where we break down what's happening in tech and why it matters to you. Now, let's dive in with your hosts.
Good morning, everyone, and welcome back to Connecting the Dots. It is Monday, September 29th, 2025. I'm Alex.
And I'm Morgan. Good morning. Ready to connect some dots today?
Always. Let's start with a quick look outside here in Sacramento. Looks like maybe some chance showers today. High around 74 degrees Fahrenheit.
Yeah, fairly mild for us. Nationally, though, it sounds like the East Coast is still dealing with some rough seas, rip currents from Imelda and Humberto. So heads up if you're out there.
Definitely. Okay, quick market check before we dive in. How did things close out last week?
Right. So looking at Friday's close, the Dow Jones finished up 0.32% on the day. For the week, it was just slightly positive, up 0.09%.
Okay, pretty flat week for the Dow then.
Yeah, basically. The S&P 500 gained 0.43% on Friday, but it actually dipped a tiny bit for the week, down 0.16%.
And Bitcoin?
Bitcoin's seeing small losses right now, down 0.17% today, and it's off about 0.66% over the past week. So maybe markets just sort of stabilizing or maybe reacting to some of the tech news we're about to cover.
Could be. All right, before we get to that, let's talk about our sponsor for today's show.
Yes, we're happy to partner with Pins and Aces. They're a fantastic premium golf apparel and accessory store.
Seriously great stuff. If you're looking to, upgrade your golf wardrobe, maybe get some cool head covers or polos, Pins and Aces is definitely the place.
And here's the best part. Use our promo code SNARFUL, that's SNARFUL, SNARFUL, at checkout, and you'll get 21% off your entire purchase.
21%. That's a really solid discount. Just head over to pinsandaces.com. That's pinsandaces.com, code SNARFUL.
All right, let's get into it. We've got our internal Snarful Tech article report, the Morningstar, ready to go. 3 big stories today.
Yeah, and our goal here, as always, is to break these down and connect the dots, figure out what this tech news actually means for you.
Exactly. Let's start with this first one. It's coming out of China and involves a company called DeepSeek making waves in AI efficiency.
DeepSeek.
Yeah.
They've popped up before, haven't they? Made some noise.
They definitely have. Their previous models apparently, quote, shocked Silicon Valley. Now they've released an experimental model, DeepSeek V3.2-Exp.
Experimental, okay. So maybe not fully baked yet.
They're calling it an intermediate step towards whatever their next big thing is. But the key part, the tech nugget here, is something called DeepSeek Sparse Attention, or DSA.
DSA, okay, break that down for us. Sparse Attention.
Right. So think about how these large language models usually work. They pay attention to all the words in a long piece of text to understand the context. It's computationally expensive.
Like reading every single word in a giant manual.
Exactly.
Yeah.
DSA, this sparse attention, lets the AI be smarter about it. It focuses only on the most important bits of information, kind of skipping the less relevant parts.
Like skimming the manual for the important diagrams and warnings.
Precisely. And the result? DeepSeek claims it drastically cuts the computing cost and actually boosts performance, especially when dealing with really long sequences of text. Makes training these huge models way cheaper.
Okay, cheaper training, better performance. That sounds good. But what's the catch? Or what's the impact?
Well, here's the kicker. They're not just keeping those savings. They announced they're slashing their API prices by 50%, plus 50%.
Wow. Okay, so that's not just a small adjustment. That's aggressive.
It's basically firing a starting gun on a price war. It puts huge pressure on their Chinese rivals, like Alibaba's Quinn, but also on the big international players. Think OpenAI, Anthropic.
If DeepSeek can offer similar, maybe even better performance for half the price, yeah, that changes the whole game.
And that's the connection for you listening. If the fundamental costs of running these AI tools, the ones powering your virtual assistants, your customer service chats, maybe even tools you use at work, if that cost gets cut in half,
then theoretically, the cost of those services should eventually come down too.
That's the idea. Efficiency improvements like this tend to trickle down. It makes powerful AI potentially much more accessible and affordable.
Okay, very interesting. Efficiency driving down costs. Now, our second story is about, the opposite of cheap, maybe. A massive amount of money changing hands.
Yeah, a huge one. We're talking about the gaming giant Electronic Arts, EA. They're being taken private in a $55 billion buyout.
$55 billion. That's enormous.
It's being called the largest all-cash sponsor take-private investment in history. All cash. It's a landmark deal for the gaming world, for sure.
Who's behind such a massive deal that takes deep pockets?
It's a group, a consortium, led by Saudi Arabia's Public Investment Fund, the PIF. They already had a stake, about 9.9%, and they're rolling that over. Also involved are Silver Lake and Jared Kushner's Affinity Partners.
Okay, so major players and the deal itself. Shareholders get $210 a share.
Yep, which is about a 25% premium over where the stock was. It's structured as $36 billion in equity and $20 billion in debt. They expect it to close in, Q1 of their 2027 financial year.
And the current CEO, Andrew Wilson, he's staying. HQ stays in Redwood City.
That's the plan. So on the surface, it might seem like stability. But going private changes things fundamentally.
How so? Less pressure from the stock market every quarter.
Exactly. Public companies often obsess over those quarterly earnings reports. Analysts think this deal is basically a bet that the games industry is now, quote, mature and predictable.
Mature and predictable. Meaning they want the reliable moneymakers.
Pretty much. Focusing on the huge franchises that churn out cash year after year. Think EA Sports FC, formerly FIFA, The Sims, Battlefield. Big established IPs.
Less focus on risky new ideas or smaller games.
That's the potential downside, yeah. Private ownership means less pressure to gamble on the next big innovative hit that might take years to pay off, if ever. They might prioritize predictable profit streams.
And EA has already been doing some restructuring, right? Layoffs, shutting down some mobile games.
Right. They shut down things like Kim Kardashian Hollywood, focusing more on their owned IP. This move kind of fits that pattern.
So for gamers listening, what does this mean for, their favorite EA game? Does it mean more reliable updates for Madden or FC, but maybe fewer totally new, unexpected games from EA down the road?
That's the big question, isn't it? It's potentially a trade-off, stability for the big franchises versus maybe less risk-taking on groundbreaking new stuff. We'll have to see how it plays out.
$55 billion question. Okay, that brings us to story number 3. And speaking of staggering amounts of money, this one is about the sheer cost of building the infrastructure for this AI boom.
Yeah, this puts the DeepSeek efficiency gains in perspective. We're talking about Oracle and OpenAI here, and the numbers are just mind-boggling.
Okay, hit me with it.
So OpenAI has reportedly signed a deal with Oracle, a contract for computing power. The price tag, $300 billion.
300, wait, billion. With a B.
Billion with a B. Over 5 years, starting in 2027, $300 billion just for the compute power from Oracle.
I can barely wrap my head around that number. What does that even mean in physical terms?
Yeah. Get this. To deliver that much compute, the infrastructure required needs 4.5 gigawatts of power, continuously.
4.5 gigawatts. What's the comparison there?
It's roughly the output of more than 2 Hoover dams. Or, put another way, enough electricity to power about 4 million homes in the U.S.
Just for this one OpenAI contract? That's insane. We're literally talking about needing dam-level power generation just for AI.
It's a staggering physical footprint. And think about the financial gamble here. OpenAI's current revenue is maybe, $10-12 billion a year?
Right.
This contract means they'd be paying Oracle $60 billion a year starting in 2027. $60 billion. They're projecting huge losses already, like $44 billion between 2023 and 2028.
So they're betting everything on absolutely massive exponential growth in AI demand and revenue to cover that cost.
Completely. It's an enormous bet. And Oracle's taking a huge gamble too, right? They have to actually build this out. They'll likely take on significant debt to buy all the specialized chips, mostly from NVIDIA, to fulfill this contract.
But Oracle must see a massive upside if they're willing to do that.
Oh, for sure. Their contracted future revenue, what they call remaining performance obligations, or RPO, has apparently skyrocketed. It's up 359% to $455 billion.
$455 billion. Okay.
Yeah, driven by deals with basically the who's who of AI, OpenAI, sure, but also Elon Musk's XAI, Meta, others. They're positioning themselves as the infrastructure provider for the AI age. They expect their cloud infrastructure revenue to jump 77% in fiscal 26 alone.
And the quiet giant in the background here is NVIDIA, right? Making all the chips.
Absolutely. Can't forget them. Their CEO, Jensen Huang, he's talking about total AI infrastructure spending reaching maybe $3 to $4 trillion by the end of the decade.
Brilliant, with a T.
Trillion with a T. So that $300 billion Oracle deal, as mind-blowing as it is just one piece of a multi-trillion-dollar puzzle Huang envisions.
Wow. So the connection for everyone listening, is this just the necessary cost of building the future, or is it kind of spending fueled by debt and the projections setting us up for some kind of massive tech bubble?
That's the trillion-dollar question, isn't it? You've got DeepSeek pushing costs down with clever engineering on one side.
Right.
And on the other, you have this almost unimaginable infrastructure build-out, costing fortunes and demanding incredible amounts of physical resources like power. The tension between those two is really shaping things right now.
It really is. Okay, fascinating stuff. Before we recap, let's quickly thank our other sponsor.
Yes, we also want to thank Skoni. That's S-K-O-N-I. Skoni. They make premium golf shoes.
If you're looking for that perfect combination of, style, comfort, and performance on the course, you really should check out Skoni.
And guess what? We've got a code for them too. Use promo code SNARFUL again, that's S-N-A-R-F-U-L, SNARFUL, at checkout on their website.
Using that code gets you 15% off your entire purchase. A great deal on some really top-notch golf shoes. That's skoni.com, code SNARFUL.
All right, let's quickly tie these three stories together from our Morningstar report.
Okay, first up, DeepSeek in China. Using that new DSA tech, DeepSeek Sparse Attention, to drastically cut AI computing costs.
Yeah, and launching a price war by slashing API costs by over 50%. This should eventually make AI tools cheaper for everyone.
Second story, Electronic Arts. The gaming giant going private in that record-breaking $55 billion all-cash deal.
Right, led by PIF and others. It signals a shift towards focusing on stable, predictable profits from big franchises, potentially at the expense of riskier, innovative new games.
And third, the absolutely astronomical scale of the AI infrastructure build-out.
Illustrated by that $300 billion Oracle OpenAI deal, needing 4.5 gigawatts of power, more than 2 Hoover Dams worth. And it's just part of a potential $4 trillion spend by 2030.
So let's leave our listeners with a final thought on that infrastructure piece.
Okay, so we're talking dam levels of power for just one AI contract and projections of trillions in spending overall. Forget the tech companies for a second. What existing public utility, think the power grid, maybe water systems needed for cooling data centers, even the fiber optic networks, which of those non-tech utilities is going to face the biggest strain, the biggest need for costly upgrades to actually support this multi-trillion-dollar AI future?
That's a great question. Where does the physical burden really fall when the digital demand gets this huge? Something to think about.
It connects right back to your bills, your services, everything.
It really does. All right, that's our time for today.
We're here to help at Snarful, so reach out on our website if you have any more questions.
Thanks for tuning in, and we'll catch you next time for more Connecting the Dots. Bye for now.
That's a wrap on today's top stories. Remember, tech doesn't have to be complicated, and we're here to help connect the dots. If you've got questions or want to learn more, visit us at snarful.com. Thanks for listening, and we'll catch you next time.